Pivot points are taught in every day trading course as automatic intraday support and resistance. You calculate them off yesterday's high, low, and close, you plot them on today's chart, and you're supposed to trade bounces off them. The reality, most pivot levels are ignored by the market. They're math, not structure, and they only matter when something else on the chart confirms them. Today, why most pivot levels fail, the Confluence rule that separates a real pivot from a random number, and the pro workflow that uses pivots as confirmation rather than entry triggers. Here's the structural problem. The pivot point is calculated as the average of yesterday's high, low, and close. It's a number. It has no participants behind it, no volume traded at it, no historical defense. When today's price arrives at the pivot, there's no inherent reason for the market to care. What makes a pivot real is when it lands at or near an actual structural level, a prior swing high or low, a volume node from yesterday's profile, or a moving average that's been respected. Math plus market consensus equals a real level. Math alone equals a line. Watch this in a synthetic intraday chart. A trader plots pivot points and treats the central pivot as automatic support. Price arrives, the trader buys, expecting a bounce. Price slices right through to S1. The trader buys again at S1. Price slices through to S2. The pivot levels never had any participants behind them, they were just numbers on a chart. The same trader watching for structural levels would have skipped both entries entirely. Here's how pros actually use pivots. They don't enter on the pivot, they enter on the price action at the pivot. They wait for an absorption candle, a rejection wick, or a volume spike to confirm that participants are actually defending the level. The pivot itself is just a reference, a place to pay attention. The trade is the confirmation, not the touch. That single shift from triggering on the pivot to confirming with the pivot dramatically improves the win rate. Now the real setup. Price touches the central pivot, prints a clear rejection wick, and volume expands on the recovery candle. Three things confirming: the pivot itself, the rejection candle, and the volume spike. The trader enters on the confirmation candle, places a stop below the wick low, and targets R1. The pivot wasn't the trigger. It was the location where confirmation was worth watching. The candle and the volume earned the trade. On a real intraday chart, plot pivot points, but don't trade them. Watch for price to arrive at a pivot and for a confirmation candle to print. That confirmation candle is the entry. Without the candle, the pivot is just a number on the chart you'll forget about 10 minutes later. With the candle, it's a high probability setup. Confirmation is more important than calculation. The math waits for the market to agree. So, pivot points are math, not levels. The market doesn't owe them respect. Use pivots as locations to watch for confirmation, rejection candles, volume spikes, structural overlap, and only trade when the confirmation arrives. The pivot tells you where to look. The candle tells you whether to act. Subscribe for the full method and trade your own plan. Education, not financial advice.